Let's talk about inventory errors in purchases. ABC reported the following amounts for years 6 and 7. We've got opening inventory, purchases, ending inventory, and cost of goods sold. For year 7, we have $35,000 of opening inventory, $280,000 of purchases, $42,000 of ending inventory, and $273,000 of cost of goods sold. In year 6, we have $28,000 of opening inventory, $260,000 of purchases, $35,000 of ending inventory, and $253,000 of cost of goods sold. Now in questions, usually we don't get the opening inventory and the purchases, but I want to demonstrate errors in purchases, and the best way to do that is actually to have numbers. ABC made one error in year 6. It recorded $9,000 of inventory purchases in transit at the end of year 6 that were shipped FOB destination, and they included this amount in ending inventory. No one discovered this error in year 6. What is the correct ending inventory for both years? What is the correct cost of goods sold for both years? Indicate the impact each year on the following: cost of goods sold, income before income tax, assets, inventory, liabilities, which is accounts payable, and total shareholders' equity. All right, let's get started. I'm going to analyze it the way I always analyze any kind of inventory errors. I've got year 6, and then for one column I've got what's wrong, then I'm going to do an adjustment in the next column, and then the final column is the correct numbers. So again, year 7, I've got the first column is what's wrong, second column is the adjustment, and the third column is what is correct. So we can see that I'm going to start with opening inventory. I'm going to add in my purchases. Now, if I take opening inventory and I add in my purchases, this is going to equal the available for sale. If I then take my available for sale and I subtract my ending inventory, this will then equal my cost of goods sold. And when I take my cost of goods sold and I flow it through my income statement, that will determine profit. And if I take my profit and I do my closing entries, that will determine retained earnings, which I'm going to denote with an RE. All right, so I'm going to put in all the numbers that I know. And keep in mind, I have to start with year 6, so be careful with that. So I've got my opening inventory, $28,000. I've got my purchases, $260,000. When I add those two things together, it's going to be equal to the total amount of inventory that I had available for my customers throughout the year. I'm going to subtract the ending inventory. And when I subtract the ending inventory, I get my cost of goods sold, which is $253,000, identical to the $253,000 which was given in the question. Now, keep in mind that there's an error in here. I know that ABC made one error because they recorded the $900,000 of inventory purchases that were in transit at the end of year 6 as inventory, but they were shipped FOB destination, so ownership didn't transfer until it arrived at the customer's door. So the entry that they made was a debit to the inventory. Okay, it increased the purchases. And that was for $9,000. And they would have credited accounts payable for $9,000. So now, purchases were overstated by $9,000. To fix them, I have to subtract $9,000. Now keep in mind that my formula for available for sale is I take the opening inventory and I add in the purchases. So I'm going to do the same thing, and we can see that available for sale now has to be adjusted by $9,000. It has to be reduced by $9,000. We know that ending inventory is too high because ending inventory included inventory in transit that we didn't own. So we have to subtract $9,000 from the ending inventory to fix it. I'm going to do my usual calculation. Available for sale minus the ending inventory, but I'm subtracting a negative $9,000, which alters it into a positive $9,000. That means the impact on cost of goods sold from this error is 0. That means profit has 0 error and retained earnings has 0 error. Now, we can go over to the correct column and we can simply add across. We're going to take the opening inventory, add in the adjustment. There was no adjustment because there was no error in opening inventory. So that means opening inventory is still $28,000. Purchases, which were $260,000, I'm now going to add in the negative $9,000. So actual purchases should have been $251,000. Available for sale, of course, I'm going to do the same math that I did before. I'm going to take the wrong number, $288,000. I'm going to add in the adjustment, negative $9,000. That means available for sale is $279,000. It would be the same if I took the $28,000 opening inventory and added in the adjusted purchases, $279,000. I'm going to take the ending inventory of $35,000, add in the negative $9,000. That equals $26,000. That is the correct ending inventory. If I now take my available for sale and deduct my ending inventory, my cost of goods sold is still $253,000. There's 0 error in the profit and 0 error in the retained earnings because there's 0 error in the cost of goods sold. Now, let's answer the questions that we've got. What is the correct ending inventory for both years? Well, we only have year 6. So the correct ending inventory was, and I'm going to highlight it, $26,000. That is the correct ending inventory. And then it says, what is the correct cost of goods sold for both years? For year 6, the correct cost of goods sold is $253,000. And I'll highlight it. So now we know the correct ending inventory and the correct cost of goods sold. Correct cost of goods sold, of course, has not changed. Now, indicate the impact per year on the following. So I'm going to highlight that this is year 6. I'm going to take all of those. There we go. All right. Cost of goods sold. The impact per year on the following? Nothing. No effect. That's because cost of goods sold is correct. Since cost of goods sold is correct, there's no effect on the income before income taxes. However, the asset inventory is overstated. By how much? $9,000. Liabilities, accounts payable, overstated. Again, by $9,000 because we shouldn't have recorded the debit to inventory because we didn't own it. We shouldn't have recorded the credit to accounts payable because we didn't owe it. Total shareholders' equity, well, since profit is not incorrect and since retained earnings are not incorrect, there's no effect on total shareholders' equity. All right, let's move over to year number 7. We're going to input the information we have from the question, but note that the ending inventory from last year, which was $35,000 when it was wrong, is equal to the opening inventory for year 7. So we're going to take that and notice the information in the question was the same. Opening inventory, $35,000. Purchases are $280,000. If I take the opening inventory and I add in the purchases, I know my available for sale is $315,000. I've got to take the ending inventory of $42,000. If I take the available for sale and deduct the ending inventory, that gives me cost of goods sold of $273,000, which is exactly the same as the information in the question. Now, we didn't have any information about there being an error in year 7. So why am I doing this analysis? Because opening inventory was incorrect. Opening inventory had an additional $9,000 in it. So in order to adjust it, I have to subtract $9,000. Now, if I take the $35,000 and I add in the negative $9,000, that gives me the correct opening inventory of $26,000. That looks like it's the only error, but actually there's an error in purchases from year 7. Because I recorded the inventory in year 6, my purchases in year 6 were incorrect. They were overstated by $9,000. that also means that my purchases in year 7 were incorrect. They were understated by $9,000. So I have to add $9,000 into the purchases from year 7 to correct them. So if I take $280,000 and I add in the $9,000, that means my purchases should have been $289,000 in year 7. So I'm just going to go over that again. Why is there an error in purchases in year 7? Because I have not included the $9,000 in the purchases from year 7, and that's where they belong. So I need to correct the year 7 purchases. Now, if I take my adjustment column, remember the formula is opening inventory, the adjustment is negative 9,000, plus purchases, the adjustment is positive 9,000. That means my adjustment to the available for sale is 0. And if I take my correct opening inventory of 26,000, add in my correct available for sale of 289,000, that means my available for sale is 315,000. So there is no error in the available for sale. That's because the error in the opening inventory, with it being too high by $9,000, and the error in the purchases being too low by $9,000, when I net those two against each other, there is no error in the available for sale. We know that ending inventory has no error, and we know because I've got no error in my available for sale and no error in my ending inventory, there's no error in the cost of goods sold. Therefore, my ending inventory remains at $42,000 and my cost of goods sold remains at $273,000. So, what is the correct ending inventory for both years? For year 7, my correct ending inventory is going to be $42,000. And my correct cost of goods sold is going to be the exact same number it was before, $273,000. So now we can indicate the impact per year on the following. So we're looking at year 7. Just let me copy this over. Cost of goods sold, no effect. Income before income taxes, no effect. Inventory, don't forget, inventory at the end of the year is not overstated or understated. It's perfect. So in this case, at the end of the year, there's no effect. Now, accounts payable. Remember that accounts payable is carried forward into the next year. So opening accounts payable is incorrect, but accounts payable for the year is correct because it did show an increase in the accounts payable of $9,000. So in year 7, even though the opening accounts payable was wrong, the actual accounts payable immediately thereafter is correct. So liabilities accounts payable has no error. And total shareholders' equity, no error in profit, no error in retained earnings, no error in shareholders' equity. Hopefully this has helped you to understand how inventory errors in purchases flow through in 2 years.